Hey everybody, welcome to this very special webinar. It's really good to see you all here. Welcome to this Let's Talk Venture series. I'm really excited to speak with you about this topic. This is a topic I'm very passionate about. I'm sure you'll be able to see just from like the presentation I'm about to give you. But if this is your first time sort of joining a Let's Talk Venture event, it's an event that we host for primarily for the VC Lab community, which means folks that are generally enrolled in the programs. Um, and we want to talk about topics that are really important in regards to venture, at least from our perspective. And, you know, as always, if you've never been on one of these webinars with us before, we make these interactive. We take questions into the Q&A. There's a Q&A button at the bottom of your screen. You can also introduce yourself in the chat on the right-hand side. So, if you want to kind of build a little bit of community and things like that, that'd be really great. So feel free to go ahead and do that. If this is your first experience with us on a webinar like this, just really briefly about us, at Decile Group, we're a company who's specializing in helping fix a lot of the issues right now within regards to the entire venture capital ecosystem, so that we can basically take this asset class mainstream, especially with regards to new and emerging managers. So we have a VC Lab program that helps new and emerging managers launch. It's basically become more or less kind of the default way for new managers to start. We train limited partners to invest in this asset class through LP Institute. We have a program called Venture Institute where we train associates and venture partners to join these funds. And we've built a suite of tools and things like that to sort of power the entire ecosystem, bring transparency to it, and make this a better place, for new and emerging managers to really kind of thrive. Okay, so what I wanted to do today is I wanted to go over really quickly a presentation for you all on a lot of important concepts, and specifically with regards to kind of becoming an institutional grade VC. And I'm going to talk about this both from the GP perspective, which is pretty much everyone on this call, but I'm also going to try to talk to you through this from the LP perspective, so you can sort of understand why things are the way they are. So that way we can hopefully help you as you sort of kind of go out and scale your venture capital firm. So let me go ahead and share my screen and get started with the presentation. And after we get through with the presentation, I'm going to go ahead and open this up to questions about various other things, okay? Let's go ahead and get started, everyone. And I really wanted to do this I wanted to sort of title this as being, looks like someone's jumping in. Sheila, can you, there you go, thanks. To talk about this more from like the trenches perspective, right? From the things that we've sort of learned just from our own lessons, okay? The whole purpose of this presentation is to help you kind of build the framework around scaling like an enduring institution that's going to be here for a long time. And that's what this presentation is going to be about. Really quickly about us, Sheila, can you, there you go, thanks. Really quickly about us, we've helped launch a lot of firms. You probably have seen some of our stats with the accelerator. The very best firms that we work with, they go into a program called Decile Partners, and we have over 70 partners right now. And we go all in to try to help them scale, okay? And then this is why I'm able to sort of give you this sort of help you figure this out really from like every single perspective, right? So we help all these firms be super successful at their craft with all of their investments and things like that. We help a lot of the talent that wants to join these firms, and we're training a lot of limited partners right now on how to invest in emerging managers, including some very large institutional grade LPs. And we're learning what their issues are and why it's a little bit like complicated for them to, for example, invest in your funds and stuff like that. So this is like the entire sort of ecosystem, right, that we're seeing. And I'm seeing this from all angles. And I wanted to bring in all this information into this presentation so you can sort of understand this. But like at this point, for better or for worse, we are more or less becoming sort of like the entire ecosystem for new and emerging managers, okay? So a lot of times we get this question, especially in the VC Lab program, And why is it so important for me to be like an institutional grade LP or a fund? Like, why do I need to be institutional? Why can't I just like do my own fund on the side and or whatever? And why can't this be sort of like a project? Why is it so important for me to build like a firm versus like a fund? Okay. And I'm going to give you this from the GP perspective, and I'm going to give you this from the LP perspective. Okay. So from like the general partner perspective, the math just doesn't work. It's not worth it for you to start a fund unless you're going to build a firm. Okay. It's not worth it for you to start a fund unless you're planning to build a firm. The reason for that is, first of all, from an economics perspective, okay, you're just not going to make that much money, right? Like it just doesn't work. Like the math doesn't really work. You can sort of see some numbers here, what a typical like fund kind of growth rate looks like. Most LPs are not going to back you in fund one. So like all the people on the call, like, well, no, I'm going to do $30 million fund one. It's like, it's super unlikely. And if you're going to get to that target number on fund one, you're probably going to do that in a way that where you're also not going to make any money because you're going to get a whole bunch of LPs that are going to put hurdle rates and all sorts of bad terms on it, just so that they can sort of de-risk their investment for them. And therefore, you're probably not going to do really well financially, right? And so the way you sort of want to think about this, at least from a financial perspective, you really want to do multiple funds. And that's when sort of everything starts to work out really well. Because in fund one, that's kind of like your MVP. You're sort of learning your business. You're probably not going to make that much money in fees. Like, I mean, let's look at this, right? It's like $1 million. Most of these funds are 10 to 12 years. So it's like $100,000 a year that you're going to have to run your business on. So that's not your salary, right? That's like for your whole business. Even at $20 million, right? Like $4 million over 10 years for you to sort of like run that business. That's not a lot of income, right? Even at like a $20 million range. Okay. And so it just becomes like it's just the math just doesn't work unless you're in this for the long term and you want to raise multiple funds on top of each other. Also, from an LP risk perspective, okay, like in fund one, they're betting on you because they don't have anything to go off of, right? Like if you it doesn't matter that you've been a really successful angel. It doesn't matter that you've ran a whole bunch of syndicates and you're super successful. That doesn't actually translate into you being a really good general partner where you're going to be managing their money for the next 12 to 15 years blindly, basically, right? And so there's just not that much correlation. And so therefore, a lot of these LPs are betting on a manager. So as you can imagine, a lot of the bigger limited partners are just not going to want to take that risk, right? So you're just going to have a small fund. And so the only reason to do a small fund is if you can get to a bigger fund two, and then you get to a bigger fund three, and then a lot of these the business, the economics of the business really starts to stack up, and now you're kind of building an organization. So you by definition need to build an enduring firm. Otherwise, it's just not worth it, and the math is just not going to work out for you. Okay. But let's look at this from like the LP perspective for a second. Okay. So like here's a chart of everything I just told you, right? So you're going to start fund one, then maybe in 2 years after that, you're going to start fund two, then in 2 years after that, you're going to start fund three. And what I did here is I have these percentages. These are like management fees percentages, okay? And I'm sort of showing you sort of what the management fees sort of look like over a 10-year or 12-year cycle, which is what most of these funds are. That's a pretty normal. Sometimes they take even longer, okay? Well, for LPs, okay, all the risk is here. What does this mean? Okay, if you don't raise a fund two or a fund three and you just did fund one, look what happens after the 2%. You're not going to make any money, right? And so what's going to happen? Are you going to work really hard to go out and get exits, or are you going to go get a job or do something else in these last 7 or 8 or 9 years, right, of the fund cycle? It's pretty hard, right? It's pretty hard. So for LPs, like if they're even going to consider a fund one, and again, most LPs don't, okay, unless they're, especially the institutional grade ones just don't, because they're like afraid of this risk here and a whole bunch of other reasons, which we'll talk about in a second. But if they're going to take that risk, they need to see or believe that you can do fund two and fund three so that these management fees can sort of stack up, and then you're going to have enough operational budget for you to run your business correctly over time. Okay. And so this stacking of management fees, which you're sort of seeing here, is actually reduces the risk for limited partners as well. So both you and the limited partners are effectively aligned on the same goal if you want to build a firm. Okay, this is super, super important to understand. So if you're going to do a fund one, you really need to get to fund two and fund three. Okay. Let me just go ahead and skip this slide for a second. So from an institutional like LP perspective, okay, they basically, if you remember anything from this slide, and this is another thing that we see a lot of kind of like pushback on and things like that, is like institutional venture capital like thrives on predictability and performance. Predictability and performance. Predictability and performance. Okay. A lot of people say, well, if I can just get you performance, like, why do you need to do all this blah, 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 blah? Who cares? You're just going to be performance. Like most LPs are not comfortable with that, right? They're not comfortable with investing in Bernie Madoff, right? Or whatever. You could be like, you can get performance, but it could be a really bad fund or a bad actor or whatever. And that's not really, really great. Okay. So the way you sort of want to think about this is that there's basically like three pillars, right, to building an institutional grade firm. And this is from the LP side, but this is also from the GP side, okay? You need to have ridiculously amazing operational excellence. And this is where most emerging managers that came before you have kind of totally messed up the market for you all. And I'm going to talk about that in a second. There's strategy alignment. So you have to agree on the goals. Remember when I sort of talked about these life cycles of these funds being 10 to sometimes 12, sometimes as much as 15 years? Like LPs need to be aligned with those types of return expectations, right? If they're asking you, when am I going to get my money back in 4 or 5 years? That's misaligned, right? And it needs to be ultra transparent, right? Like, just like, many of you probably have investment accounts in other things like Schwab or Fidelity or something like this. You're not that different. You're the same, okay? You're the same. Or maybe another better analogy that I can give you is you're like a doctor, right? And here in America, for example, where I'm at, right, a doctor not only has to take the Hippocratic oath, in our case, similar analogy for us is the Mensarius oath, but you have to be licensed correctly, right? There's like serious malpractice if you mess up, right? This is like serious, serious stuff, right? You're not that different, right? You're like basically at that same level. So you have to run an organization that really does well by your LP's money, right? So that means you need super robust compliance. This is one of the areas where most emerging managers have completely messed up the entire ecosystem for you all. So now I'll talk about that in a second, what the consequences are for most of the people on this call, because many folks have done that. There's like serious ethical dilemmas, like, can I invest in a company that I angel invested in before the fund? That's a serious ethics issue, right? You have like super robust governance, like, okay, when do we double down on this investment or not, and things like that. And you have a really good way to think about managing risk, like, okay, do we sell into secondary or not, whatever, that kind of stuff, right? And if you have like a lot of these things, now you're sort of running like a Fidelity or whatever, even though you're like a $5 million fund, and then you reduce a lot of that risk off the table for limited partners, especially the more institutional grade ones. And now they want to sort of build this long-term relationship with you and be in fund two, fund three, fund four, fund five, and eventually you become sort of like an enduring firm, okay? We sort of talked about strategy alignment a little bit, but about especially the long-term stuff, but really like just having like a shared vision, right, on what you all are trying to accomplish is super, super critical, right? Like if you have an institutional LP that doesn't really care about the thesis or the mission of the fund as much, and they're just doing it for pure returns, maybe there's a misalignment there, right? And then finally, like the way you sort of talk about performance and reporting, it's super robust, super consistent. they can trust it just as much as you trust whatever information you're sort of getting from like a Fidelity right now, right? And it's at that level, okay? And that's when you sort of have maximum alignment, and that's key. That's the whole predictability component of everything we're talking about here, okay? So you have to have predictability for this to make sense, right? Now, because most emerging managers that have come before you have had super suboptimal operations and super suboptimal reporting, right? Institutional LPs have like done a lot of, they sort of de-risk this in kind of a bad way, right? They end up, hitting you with side letters and all this other stuff, and you just don't really want that, okay? So let's talk about some intangibles and sort of how to de-risk this in the future. Okay, so what does operational excellence look like for any firm, whether you're emerging or not? It kind of looks like this, okay? Super robust legal operations with like conflict management and everything like that, okay? Super robust compliance, like a ton of emerging managers don't even do KYC and AML. Could you imagine that if you're an LP, okay, and you invested in some fund and that fund took on some like a criminal or something, right? Bad, like you don't want to be part of that. Like right now, sanctions, hugely problematic, okay? Hugely problematic. If somebody takes an LP from like a sanctioned country right now, the bank will shut down that account and lock down the money for all of the other LPs. Super bad, right? Like that's just awful. You don't want to be in a situation like that, right? So there's all sorts of regulatory compliance and things like that that are critical. And a lot of times up until like more recently, emerging managers have typically like ignored a lot of these issues, right? And as a result of that, they've created a lot of risk for LPs, especially institutional ones, because most of the risk for limited partners is in compliance and treasury, right? It's like, is this run correctly? Is this like a super high-end, high-grade sort of operation and things like that? And that is, and if you don't have these, right, then you become incredibly risky. Are they going to get the right amount of distributions, right? Is the bank account going to be shut down or not? These are like serious things, right? And so, because emerging managers historically have cut corners on pretty much most of these things, they've historically been super unsafe for LPs. Okay. And the reason that, emerging managers cut corners oftentimes is because of cost, oftentimes is because they don't have a point of view, or other times they don't care. Right. And so those are like some issues that have come up. So what do LPs do? They try to mitigate the risk legally. Like they'll hit you with super hardcore side letters. They'll put like hurdle rates on you, right? And a lot of people misunderstand hurdle rates. Like if you have like a 10% hurdle rate, that means, you might have to clear like a 3x or 4x on your fund, which again is above market average, for you to have any carry. So you might be sitting here like managing this money for 12 years and not have any carry. Think about that, right? But like they have to sort of do that because like a lot of these funds are just so unsafe to invest in, right? Because a lot of people cut corners, right? They force rigorous audits on you. Okay. And these audits are not cheap, right? They're like $40,000, $50,000 a year extra, but they're like, I don't trust the reporting from this manager, so I need to do that, right? They'll try to take seats on your limited partner advisory committee so that they can make sure that they are the ones involved in clearing your conflicts because they don't trust emerging managers, right? And it's not because they're bad people, okay? It's not because they're bad people. They actually have very, very, very good intentions, right? It's just that they don't have other choices right now, because of the issue they are. So they're just trying to solve this through legal agreements, which is not a great way to do it either. But that's just what they feel like they have to do because a lot of the market is super unsafe. Okay. And it's not your fault, right? To be clear, I also want to say, like, I'm kind of like, feels like I'm bashing on emerging managers. I'm not. It's just most of these like providers don't like deal with this, right? Like if like Carta and AngelList, like all these like type of fund admin providers, they're just like doing like accounting and like basically filings. Okay. They don't have like compliance. The law firms don't want to touch this. They don't want to deal with any of this stuff, right? They don't want to like manage through all this stuff, right? And so it's also just an industry like education thing, which is why I'm wanted to have this call here with people so you can sort of understand like the issue. And it's, it's not, I'm calling, just a couple of vendors here, but it's pretty much most vendors, right? And the reason for that is because they don't want to have to deal with this. Right? It's kind of a lot of responsibility to sort of have to deal with compliance, right? Because if you do something bad, they can sort of like turn their head away. It's like, well, I'm just doing accounting. So if this person took money from an LP or from a bank account that doesn't match the legal agreement for that LP, hint, money laundering, right? I'm just doing the accounting, right? I'm just doing the accounting. So I don't need to look at this. I don't need to look at this. Like, I don't have to worry about it, right? And so that's the issue, right? That sort of happens. And the market sort of doesn't understand this very well. And a lot of people cut corners on these things, right? So if you're on this call, don't cut corners on these and things like that. Now, the way we're solving this with all of our Decile partners, and hopefully if you're a vendor on the call or something like this, the way we deal with this is the exact opposite, right? We're very proactive. We work with all the managers. We tell them, hey, that's a huge issue. Do not take that money. That money doesn't match the bank account or the legal agreement, right? Everything's integrated into one place, right? You don't have like to use like 7 different vendors to kind of get everything that you saw on that previous slide. And it's sort of trained, they're sort of trained to be institutional from the beginning. So when LPs invest in Decile partner funds, they don't have these risks effectively, right? And so when I'm training all of these new set of LPs and I'm saying, hey, start by doing diligence on Decile partner funds, a lot of this risk is basically taken off the table, right? Because they don't have to worry about that because it's all sort of integrated into like one place, okay? So what can you do right now to sort of get like institutional ready? You know, on a high level though, this is super important what I wrote here below. LPs want you to do what you say you're going to do. Everybody goes around like, a deck, like kind of saying, I'm going to do this, I'm going to do that, whatever. And a lot of people don't. Okay. So that's super important. Okay. So let's just start with like some principles. All right. First of all, you have to be like a super ethical and like honest about like what you're doing. Okay. Like, don't like try to like make things appear better than they are. Okay. So how does this end up seeing? I'm seeing this a lot, for example, where people try to say that they have track record, even though they have absolutely no attribution for that track record. How does this work? Well, somebody maybe worked at a VC fund before, maybe they were a principal, maybe they were even a partner, right? And then they're like putting in their deck, well, I invested in these 8 companies and they got marked up like this. Well, that's not your track record, right? It's the firm's track record. And therefore, you must get attribution from that firm, because when an LP looks at that, they're going to have to talk to that firm and figure out exactly what you did with that deal, right? Were you instrumental, or did you just have a vote? Were you on the board? Like, what happened with that deal? And so a lot of people misrepresent like track record, for example, in their materials, right? And so just be honest with yourself, right? Like if you don't have this, don't push the boundaries on what you don't have, and be honest with your LPs, okay? Build a super rigorous process and institution, right? Like build these principles into this. It's like, no, we're not messing around, right? We're not going to take people into our fund that have potential issues with KYC and AML, irrespective of how much money they put in. Like we have principles around that, right? And we're going to be super professional from the day one. Even though this is a tiny little $5 million fund, our inspiration or our goal is to become a very large institutional grade firm. And so even though we're $5 million, we're going to act like we're 100 or 200 or $500 million venture firm. Okay. Then when you go out and start to fundraise, right, you have to be able to prove to LPs that you have operational excellence. It just has to happen, right? And if you sort of do things correctly from the beginning, that's great. And then, when you have to fill in these like gnarly DDQs for all these LPs that you will need to do to get millions of dollars from them, right? You can fill those in well. Also, you can say no to LPs with like side letter requirements that don't make any sense, right? Because you're institutional grade, you're doing well, you're going to be able to go to another LP and might be able to get this done in a much cleaner way, right? And so this is why you also have to set expectations correctly, right? Like, why do you need the side letter? Why are you trying to kill me with this hurdle rate? Aren't you like, well, don't you want me to be successful and make you a ton of money as a result, right? Like, don't we both want to be successful, right? So you want to make sure you have like maximum alignment. And I can't stress this enough. You have to have an exceptional team, and this is an area where we have to spend a lot of time like fixing stuff in the VC Lab program, for example, where somebody basically brought in a general partner or something like this to kind of try to make them more institutional grade. And oftentimes that partner like didn't deliver on expectations because they didn't understand this stuff to that level. They didn't understand operations to that level. They didn't understand the rigor to that level. And so they ended up in a difficult spot. And now they're not really fundable at all. Now they're fighting or whatever the case may be. So you just got to build an exceptional team. And if that's just you, then it's just you. It's all good. 66% of VC Lab alumni are solo GPs. And it's fine. You can build an institutional grade firm as a solo GP on fund one, and then you can bring on partners in fund two, right? So just always think about like, how can we sort of level up and have an exceptional team? So let's talk really quick about diligence. What happens with diligence when you sort of scale beyond like kind of like the high net worth individuals, which most of you are going to be spending most of your time on as you're sort of raising your first funds? Well, they're going to have an extensive DDQ process. So DDQ, for those of you that don't know, is like a due diligence questionnaire, and it's large, 50, 100 questions, right? They're asking everything, right? They're basically looking at everything you've done, which is, by the way, why you need to be institutional grade from day one. A lot of times we get this questions like, well, why can't I just like sort of like cut corners and MVP my fund and use some like janky fund admin provider or whatever just to save some costs, and like a lawyer that doesn't understand venture, which is another issue that we see a lot, right? Because it's just fund one, right? And I'm just proving the concept. And when I go to fund two, like, guess what? They're going to look at fund one, right? You don't think they're going to ask you if you had like side letters in fund one? And this is a whole nother issue that we're seeing right now, because you're seeing this with other programs that are sort of popping up right now, and then they're like disguising these service agreements as like side letters, and they're terrible, and they're actually going to hurt fundraising in fund two and fund three. And so then the LP is like, nah, I don't want to be part of that, right? And so you're going to have to be able to be super buttoned up, and you're going to have to be able to disclose everything. And then if you have that, and you have that in a nice organized fashion, this process can actually be relatively smooth for you. Okay. So be institutional from like sort of day one. Okay. You're going to need a super professional data room. Okay. Like, this isn't like some Google Drive thing, some Notion page or something. Okay. You need like a robust like data room where you give them like reporting. You show what your previous reports look like. You're going to have like references and stuff in there. You're going to have, obviously your materials or your legal docs, everything that you sort of need to kind of pass that. And, happy to answer more questions on that if you need. And then just be ready, okay? Because they're going to be doing a ton of off-list references. So just to give you a sense, just for us, right? So for our own fund of funds, and again, our fund of funds has probably more data on new managers than any other fund of funds, right? Just because every cohort that we run gets 3,000 plus applications, right? And the best of the best end up being in partners. So we have like a level of detail and transparency of execution that very few fund of funds do. And even in our case, we're doing 15 plus references, even though we know the manager at a level that most fund of funds don't, right? And so could you imagine what it's like when you go into another kind of LP that doesn't know you as well as you do? They're going to like do a ton of work. It's like 20 something like level references, right? So just be ready for like all off-list references, because again, they're hiring you to manage their money for like the next probably 15 to 20 years. That's a pretty serious commitment. So it makes sense, right? That they need to be sort of cautious about this, right? And so just be ready, right? Because people are going to ask and they're going to find things out. So be ready for this sort of scrutiny, okay? So get ready now, right? pick like institutional grade vendors, right? Do not work with like a lawyer that doesn't only work with basically VCs, right? Like just because a lawyer formed a bunch of PE funds and works with startups and other things like that, right? Like that's not good enough. You have to work with specialists, and these specialists are expensive, okay? And you have to be able to, don't cut corners. Yeah, you're gonna have to spend money on this stuff, okay? And so just make sure you work with the right vendors for this stuff, right? Like Decile Partners is a good one for this, but there's others as well. Make sure that your operations are robust. So it's not just like your vendors, but how you sort of run your business. Like how legit are you trying to build this business? And then you got to make sure you have maximum alignment with LPs. This is like a huge problem, right? Like if you have an LP that's saying, hey, I'm down to invest in your fund, but I need you to take my money and invest it in only my country, and you are more of a global or continent or a place like, or you have different filters and a different thesis, you can't make that compromise. It doesn't matter if it's close enough to your thesis. You just can't make that compromise, right? So these are some things that you need to do. But at the end of the day, you got to be committed to building an enduring firm. Otherwise, it's just not worth it. Okay. It's just not worth it. It's not worth your time. Seriously. Right. So really quick about partners, right? Like Decile Partners is an offering that we have for top alumni in the VC Lab program, and it helps you build this sort of institutional grade firm from day one. And that's why we have an application process. We don't just like work with anybody. We want to make sure that there's maximum alignment from our perspective as well in you building a successful firm, that you have the potential to be top decile. So if you do apply, we do put a lot of time to make sure that this does make sense for you to sort of do that. And so if you want to learn more about that, you can just go to decilegroup.com/decile partners. And of course, we can put that in the chat and you can also apply. So I'm going to stop right here. Hopefully this was useful, and hopefully this was helpful for other folks here as well. I do see that some comments came into the chat. If you have questions for me, okay, there's a Q&A button at the bottom of your screen. All right. And so make sure that you put in questions into there. And then if you can please upvote the questions that you're most interested in seeing, I will go ahead and prioritize those. Okay. So there's basically two questions, one from Aaron and one from Eric, and they're kind of along the same line. It's like, I showed this graph, right, with, when you start fund one, when you start fund two, when you start fund three, what's sort of like the, you know, the time between when you start funds. And for most firms, it's like 3-ish years. The average is 2 to 4. So for example, the way it usually works is that going from fund one for fund two, it's usually pretty fast. It's usually like 2 years, and sometimes from fund two to fund three, sometimes it could be 3, sometimes 4 years. Every single limited partner agreement, at least if you're working with a reputable like law firm kind of thing, is going to have this thing called a successor fund threshold. Okay. And what it says is that, hey, you have to invest X amount of the fund, average is 70%, just so everybody knows, of the fund before you can start raising fund two, which is fair, right? Like if you're an LP in that fund, you don't want that manager to like take your money and then start focusing on raising money for fund two, right? Like you need them to at least invest most of it before they can go to fund two. Now it would be unfair if you require them to, deploy the money for like 100, like 100% of the money before you can go to fund two. And then for most people, that tends to be in sort of that 2 to 3 year time range. So you're going to take, that's kind of like the typical thing. And then, Aaron, what's going to happen is you're going to have multiple funds kind of at the same time. Okay. And that's what I meant by that slide where I showed management fee stacking. And so you're going to be making money off of all the funds at some point, and that's when it becomes a pretty good like sense of revenue for your business. And we have an entire article on management fees, and we can maybe post that in the chat. There's a question here from like an accelerator perspective. And it's basically like, hey, you know, we're an accelerator, we make these smaller tickets. We're considering selling our investments to other funds on the secondary market. Should we then shorten the accelerated period to allow for more time to exit? And is this a good strategy? So Gonzalo, it just doesn't really, that's not really realistic in venture. So let me just kind of take a step back on this a little bit and kind of help. If you're an accelerator, you're by definition basically pre-seed or seed. And your best exits are going to take a long time to happen. So the way venture works is it's like an outlier business. Two or three of your investments, sometimes one, are going to be the difference between whether you 10x the fund or 2x the fund. Okay, it's like that big. Generally you're going to have one investment that's going to, like, by itself, if let's say you in your accelerator you have 30 investments that you're making off of a batch, you have 27 that are going to go to zero, right? One that's probably going to return the entire fund, and two more that are going to be like a multiple of the fund, and that's how sort of you make the money. And the ones that have the potential to sort of like give you that level of return for the fund, typically, historically, are generally ones that are going to become very large. So by definition, that's going to take longer. Okay. And so it's hard to build a model on early liquidity in venture. That doesn't mean that there's something wrong with secondaries, because there's not. You may want to be able to sort of exit in the secondary when the company that you're looking at could, again, double or triple the entire fund by itself, right? But the reality of the situation is that secondaries don't really work very well for early companies with little traction. There's not a super developed secondary market to begin with, so it's not like it's super like transparent, and the whole industry is a cottage industry, right? I just spent the whole call basically talking about how kind of professional a lot of this whole entire thing happens. Like secondaries are even like less developed, right? So it's not like a super realistic option for you. And so the way you sort of want to think about this is that you want to optimize for these large outlier returns, basically, right? And when they become outliers, then there's probably a healthy secondary market because they're just incredible companies, but there's not going to be a healthy secondary market before, generally. All right. So hopefully that helpful. So that's how you want to think about this. And yes, as far as extending your fund duration, just keep it at 10 and then do like 2 1-year extensions, basically. So sort of what you want to do here. What percent of VC Lab alumni launched Fund 3? Well, Atlan, VC Lab's been around for 2.5 years, 3 years. So most of the cohort 1 people are starting Fund 2s right now, FYI. That being said, we've had a lot of people join the program as a Fund 2 or as a Fund 3. So we've had a lot of people launch Fund 3s through the program. But I think what you're trying to get at is like the people that started a Fund 1, how many they got to Fund 3. And it's like, I would say like anybody that started a Fund 1 in the last 3 years is not going to be on Fund 3 right now, irrespective of if they're in VC Lab or not, just because of all the timelines I talked about earlier. So hopefully that's useful there. Yeah, so Atlanta, I also answered your question about the fund deployment. So hopefully that's useful as well, because I talked about that earlier. Everyone, I got 17 questions in 20 minutes, so please go through and start upvoting stuff, because I do want to, I might not be able to get through everybody's questions. Okay. How do you manage expectations of LPs, investors, and end users as a firm, it's hard to balance a firm acting as a VC firm. Well, you're not acting as a VC firm. You're going to launch a VC firm, or you already have a VC firm. And so as long as you are committed to launching or building this like large or this enduring institution, then you're going to be aligned really, really well with everybody else, and you're going to make the right decisions to be aligned with everybody else, and you're not going to cut corners. And hopefully that's like the emphasis of what I'm trying to do here with this presentation here. If you don't have a robust track record on how you should present yourself in your deck, Lauren, nobody has a robust track record. Okay, like I just like people like misunderstand track record. Here's what track record is, Lauren. You're on fund 4 and you've had, fund 1 has, already 5x DPI. So in other words, you've already returned money to investors. Okay. That's track record. Okay. So like by definition, if you're an emerging manager or if you're on this call, you don't have track record, at least from an institutional LP perspective. Okay. You don't have track record. I don't care if you've managed lots of SPVs. I don't care if you've were a super famous partner at a very large firm. Again, you probably don't have attribution. So you, by definition, don't have track record. So like nobody really has like track record. And so if you have anxiety about that a little bit, just know that you're just like everybody else. Now, some people have done relatively well as angels or very well as angels. I mean, we've had people with hundreds of angel investments, okay? Multiple unicorns, okay, as angels. And they're still like not having an easy time raising a fund. It's a very different thing, right? And so like, don't worry about it is what I would say. Focus on your like strengths, focus on your secret sauce, focus on why you're uniquely qualified to overperform. And that's how you're going to raise the fund. And there's a lot of materials on this on the Go VC Lab website. Do you critique pitch decks for new VC funds? In the program, yeah, we spent a good amount of time on this. Okay, I think we already answered this question. Is it typical to set aside certain part of Fund 1 for follow-on investments into portfolio companies? If so, what should we expect? I mean, people do stuff like this all the time, but the reality is that you probably won't be able to do it. Okay, like just if your fund is anything lower than 20 million, you're just not going to have enough money left over generally for reserves. And most of these fund ones are going to be really small because you're basically raising it from like people in your network that know you super well and their friends effectively, right? Because most LPs, again, are generally afraid to invest in these funds or are prevented by charter to invest in fund 1. So your fund 1 is going to be like $5, maybe $10 million. You're just not going to have that much opportunity for follow-on investments. So what you're going to do is give that to LPs via SPVs. Okay. There's a question here, what's the difference between VC Lab and like Decile Launch and stuff like that? So, our company's called Decile Group. Decile Group runs the VC Lab Accelerator, which is, as I mentioned at the beginning of the call, maybe you missed this part. And that's become sort of like the way that people start funds these days. We've launched 470 something firms. Decile Launch is an offering where we basically like form the fund, empower the fund, do administration on the fund and things like that. And we do that for the best performers in the VC Lab program. And there's like an application for it. And so that's what that is. And that's why I mentioned it here. Could you do a deep dive into venture partner compensation? Yeah, so we have an entire agreement for this, Dimitri. But just remember, everyone, venture partners, you cannot sign any agreements with venture partners until after you've done the first closing on your fund. And as a matter of fact, you cannot sign any agreements with anybody, like in general, because you don't have a fund, and if you've already started forming your fund and you don't have signed letters of intent from limited partners and you're on this call right now, please stop. This is one of the biggest mistakes that we see people make. And this is a way that people get burned all the time and then end up wasting a lot of money and having to throw away $50,000, $100,000 worth of legal that you just can't recoup. So just stop. So Dimitri, what you want to do is take a look at the venture share agreement. So Google VC Lab venture share agreement or go to go vclab.com and go to the venture share agreement. And that's where you will see an entire rubric on how to sort of have a discussion, not in writing, but a discussion about the type of carry that makes sense for all these folks. And we'll put that in the chat as well. So venture share agreement, we'll put that in the chat. How important is an LP network? Will a good thesis raise a fund even with no prior network? You can't be a VC without a network. Let me just start there. It's a network business, and that's something we look for in the VC Lab Accelerator when we do the admissions and stuff. If you don't have a network, you're not going to get follow-on financing for your companies. You know what I mean? Like, it's just really, really hard to be successful as a VC if you don't have a great network. Okay, so if you don't have a great network and you want to be a VC, you should build a network now. And yeah, like most people that are going to raise a fund are going to raise it from people in their network. Okay. Sometimes they're new LPs to this asset class. Some of them are experienced LPs, but generally they're going to raise the fund one from people that they know. What is the average GP in a firm? It doesn't work like that, Eric. I think you want to sort of think about this the other way around. You do not want to partner with people that you do not know extremely well. We just talked about like building an enduring firm. Remember when I had the slide fund one, fund two, fund three? That's like a 20-year commitment right there. 20 years, right? Each of those funds is 10 to 12 years, right? And each starts like, 3 years after each, right? So you're like basically like that. And that's just to get to fund three. Most institutions are going to have fund 4, 5, 5, 6, 7, that kind of thing. And so you don't want to start funds with people that you don't know. This isn't like a startup. You cannot start funds with people you don't know. You have to know these people really well. You have to have worked together for a long time, and you have to be aligned on the expectations that you all are going to be doing this together for like the next 15, 20 years, probably longer, right? And so you don't care. Like it's like the way you sort of want to think about this is, if I'm solo and I don't have that partner right now, I'm just going to do it solo. If me and my friend are like super committed to launching this VC firm, let's make sure that this is something we both want to do together. And then we're going to launch this VC firm together, right? That's sort of how you want to think about this. This isn't like a startup or something where people like, oh, I need to see 2 co-founders and therefore the fund is less risky and I want to invest. This is different. Like I'm hiring Eric to manage my money for 15 years, even though you probably have never managed money professionally before. It's a huge ask, okay? Huge ask. So, like you got to de-risk that by making sure that, they're investing in you. How many LPs do you make introductions to? We don't make introductions to LPs, Outline. You should not be joining VC Lab to get introductions to LPs, and you should not be joining any program to get introductions to LPs. Dude, I just spent the whole entire call, right, talking about just how unsafe the whole thing is and like how much of a cottage industry this is, right? That's why none of these programs work, okay? Because think about this, right? Like if you're super safe, if you're not safe to invest in, like what if I was to make an introduction to a fund that didn't do KYC or an AML or something on their LPs? Like, am I going to feel comfortable being like safe? You're safe enough to invest in them, right? So we don't really do that. What we're doing right now is we're training a lot of LPs, and top decile partners that are performing really well, usually ones that we've already invested in with Decile Capital that are super de-risked, right? Get to meet with the new LPs that we're training, right? Because then it's like, I know there's a very robust safety layer where the only risk for the LP is the manager strategy. I'm not risking whether that person's going to be Bernie Madoff, and it's my reputation that's on the line. And that's why no marketplace, no program that says, hey, I'm going to introduce you to LPs ever works, right? Because this is not like investing in a startup. It's not like investing in a startup. I'm hiring Altlon to manage my money for the next 15 years. It's super crazy, right? It's like a huge issue, right? And so like, I need to make sure that you're safe. So if you are thinking about joining VC Lab, and you're on the call, you're thinking about applying for VC Lab because you want LP introductions, don't come here. It's a really bad use of your time, and we're not going to give you any LP introductions. I don't even want to give you LP introductions, right? Like that's like a really bad kind of misaligned expectations. Okay. Most fund ones are raised by people that you know. Most random LPs are not qualified to invest in your funds. Now, our fund of funds is more qualified than most because we specialize in new managers. But even for us, right? Like just think about that filter, right? Like every cohort, 3,000 down to like maybe 50 graduates, right? And we've done this 14 times. Okay, and the fund of funds is gonna make like 10 investments. It's like, like just even though we've seen 10,000 applicants, so it's just like it's just not easy for new people to invest in new managers that don't know you. Okay, there's a question here from Robin. I'm 64. So looking how much I can get done before I'm 74. I'm involved in an accelerator, and and then they said that the VCs are no longer investing in Web3 if there's a plan to list a token. A couple things on this, Robin. So yeah, it's if again, if you're going to do a VC firm, you really kind of want to sign up for like 20 years. Meaning 15 on the lower end, but 20 is kind of like the long-term thing you want to sort of think about. And so that's something you got to keep into consideration. As far as like crypto and Web3, we're seeing quite a lot of activity there, but most VC firms that we're working with are ones that are primarily VCs. So they're not like, investing in like liquid tokens. They're not like running them like a hedge fund or something. So, but we're seeing quite a lot of good activity there. So it does work. But yeah, they're not going to invest in like tokens and stuff. And as a VC, that creates a lot of problems for you. So I'll just leave it at that. Yeah, we're developing an impact fund, so we're not targeting top decile performance, but rather high impact areas for LPs. That's bad, James. Don't do that. This is where impact funds get into the most trouble. Don't do that. I'm glad we had this in this place, which is safe, but don't do that. Okay. Impact funds have the potential to create more returns than normal funds. Okay. Actually, one of our best, I think our best performing fund that we've invested in is an impact fund, James, right? Because impact companies typically solve the biggest problems humanity has, like Tesla or whatever your company you want to pick. So they're naturally going to pick, they naturally have the potential to create a lot of high returns. Okay. And that's the way you want to think about impact funds. You cannot have impact without performance. It's impossible. You cannot have impact without performance. It doesn't matter if you fund a whole bunch of SDG companies or a bunch of companies that are a certain type of founder archetype or something. If those founders don't go out and build big companies, they're not going to have the impact that anybody wants to see. You, your LPs, nobody. So everybody's out of misalignment when you say that, okay? You have to have performance no matter what, okay? And if you don't do that, you are going to struggle to raise this fund because you're automatically going to get bucketed into like the nonprofit-y world, but you're not really a nonprofit because you're kind of a fund. So you're by definition for profit. So you're like going to reduce the amount of potential LPs that would want to invest in something like this to very little. So you are just really going to struggle. Okay. So I wouldn't like, I think this is a mistake personally, and I think what you sort of want to think about here is how do we, right? How do we make the most amount of impact by investing in the best companies? And if you do that right, then a lot of LPs will want to invest in that because that's why LPs invest in venture capital. It's a very positive asset class. You're funding the future of innovation. It's the most optimistic style of investment you can do. And now all of a sudden your pool of limited partners will grow, right? So good luck with the project on that. Can I join the cohort if I'm going to be a fund manager in an existing fund that needs serious restructuring and fundraising for their second fund? I would say you can if you can get all the other partners involved. Okay. Because otherwise what I'm going to do is I'm going to teach you a bunch of stuff. You're going to take it to them. They're going to resist. And then it's going to be, it's not, we're none of us are going to get anywhere. So if you want, bring the other partners in and we'll try to fix whatever you need to get fixed, but it won't work if it's just you. Okay. There's a question on pricing. The 50K for Decile covers the setup, and what's the 25K? Yeah, so everyone, if you're going to go and form your fund, whether you work with us or not, you're going to spend $50,000 to $100,000 in legal. Okay, and if anyone's quoting you below that, then they don't know what they're doing, and you should run away. Okay, like that's the market. So what we're saying, so that's basically what we're doing. We're forming it for 50K. The fund pays for it, so you don't pay for it. Okay. This is also super normal, right? And then of course you're gonna have administration fees, right? Like everybody does. And it's like, that's what the 25K is on a regular basis. And of course you don't pay for that either. The fund pays for that. Okay. So it's like super fair. That's why there's an application process for this, because we want to make sure we work with mission aligned people, and that if we're going to like kind of provide this at this sort of like flat rate, we want to make sure we work with the right people. My fund is formed. I have service provider as accepted a core. My question is, am I still eligible to be part of the Decile launch, the Decile fund of funds? Dave, look, we can make off thesis investments, but the probability that you're going to get money is basically zero. Okay. And most LPs will never be this direct with you, but I am. Okay. Think about like all the stuff that I'm going to have to go in diligence because of however you've like run your operations. You're introducing so much stuff. You probably don't have some of the stuff I've talked about today, right? And so you're just making it super hard. And there's all these people ahead of you, like hundreds of people that are partners that I know are super safe, right? That makes it like so much easier for us to sort of make that happen. So generally, no, of course we can do off thesis, and every fund will say we'll do off thesis, but I mean, as a general rule, you probably want to at least consider switching over to partners. But I don't think you should do it for the fund of funds. I think you need to do it because, again, right now it's a lot of work to manage these vendors, and most of these vendors are just not doing it right. And I think you can kind of see that. All right, everyone. Hopefully this was helpful. Hopefully I've given you some good advice here. Again, if you're considering applying for VC Lab, admissions are open. And I will talk to you all later. Goodbye.